Brad Evans, one stock you like in the Heartland Value Plus Fund is Zepp. This is an Atlanta-based chemical seller, big in car washes. Stock hasn't done much in the past 2 years. Why do you like it?
Well, Zepp is a materials company that is masquerading as a consumer discretionary company. You go to Home Depot, you'll find Zepp cleaning products throughout the store. As you mentioned, they own the vehicle car wash market. You go to BP, you buy some gas, you get a car wash, their cleaning chemicals will be sprayed on your car. Zepp has had a number of operational missteps over the last 2 years. A botched SAP implementation, they've been struggling with raw material headwinds on top of a large fire at a key aerosol plant of theirs. So we're anniversarying a number of headwinds. We've got some tailwinds building with raw material deflation coming on the horizon. Packaging costs are coming down. We have a company that is at $17 today, has a $400 million market cap, $200 million in debt. We think normalized earnings power is north of $150 per share. So we're paying roughly 11 times normalized earnings for a company whose peer group we think is more comparable to a WD-40, who's very dearly valued at well over 25 times earnings.
Well, let's go from cleaning chemicals to milk, because you're also a fan of Dean Foods. This has been a very volatile stock. Why do you want to stick with this one?
Well, Dean Foods is similar to Zepp. They've had a lot of things that have been beyond their control penalize their P&L, namely an insatiable demand for milk out of China as a result of a contamination scare in that country over 2 years ago. As a result of that, global milk prices, global dairy prices skyrocketed, and in response, we've seen a supply response. Supply of raw milk, butter, and cheese are rapidly growing. Dean Foods is a processor. They like deflating raw material costs. We think there's a margin recovery story here. The company has a market cap of $1.5 billion, an enterprise value of $2.4 billion. We think on a more normalized environment, the company should be generating $500 million of EBITDA and substantial free cash flow. So we think we're paying less than 5 times a normalized debt-adjusted cash flow multiple with a very strong free cash flow profile, which is going to result in return of capital to shareholders over the next, hopefully, 12 to 18 months.
Finally, you're a fan of Federal Signal. Now they make street sweepers and water vacuums. They even have a product named the Guzzler. Pays a nice little dividend around 1.6, 1.5%. Tell me why you like it.
Well, Federal Signal really is a misunderstood story. It's not widely followed on Wall Street. Roughly 3 analysts cover the name. As you highlighted, they have leadership positions in their markets, sweepers, the vacuum trucks, safety and security products. There's still a margin story, a margin recovery story in Federal Signal. Much of it has played out, but what we love is actually the balance sheet and the free cash flow profile. The company is almost debt-free, generating substantial free cash flows, upwards of $75 million per year. They're buying back stock aggressively, and their end markets are actually improving. We see the municipal markets are key for them, and we see municipal budgets as improving and driving further demand for street sweepers as well as vacuum trucks.
All right, thanks a lot, Brad.
Thanks very much.
Thank you for watching The Street.